Here's a question most people never stop to ask. How does a country take over global industries without announcing it? No invasion. No dramatic collapse. No single headline saying, "This is the moment everything changed." And yet, that's exactly what's happening right now. If you look at the products around you, your phone, your car, the electricity powering your home, the shipping container that delivered your last online order, there's a growing chance that the most critical parts of those systems now depend on China in ways that didn't exist just 15 or 20 years ago. This isn't about cheap toys or low-quality goods anymore. Those stereotypes are outdated. What's quietly changing is who controls entire industries, not just who sells the final product, but who controls the factories, the supply chains, the refining, the logistics, and the know-how that make those industries possible in the first place. And the unsettling part is how little noise this shift has made. There was no single turning point. No obvious before and after moment. Instead, it happened the way real structural change often does. Slowly, invisibly, and then all at once, when it's already too late to reverse. Most people still think of China as the world's factory, a place that manufactures things designed elsewhere. But that mental model belongs to the early 2000s. Today, China is no longer just assembling products for Western companies. It is increasingly designing them, scaling them, and pushing competitors out of the market. What makes this especially difficult to spot is that industries don't disappear overnight. They hollow out. Production shifts gradually. Investment dries up quietly. Talent follows opportunity. By the time politicians start arguing about it, the ecosystem that once supported those industries is already gone. And this raises a deeper question. If global industries are being reshaped without dramatic headlines, how do you even recognize it while it's happening? That's what this video is about. Not a conspiracy. Not a sudden collapse. But a step-by-step explanation of how China used policy, scale, and coordination to move from the edge of the global economy to the center of it, industry by industry, while much of the world was focused elsewhere. To understand how this happened, we first need to go back to a time when this outcome seemed impossible. For most of the last half-century, the global economy followed a pattern that felt almost natural. Advanced countries invented things. Developing countries made them cheaply. And over time, those developing countries slowly moved up the ladder. Economists even had a name for it, the flying geese model. The idea was simple. One country leads an industry. As it becomes richer and wages rise, it gives up lower value work. That work moves to the next country in line. And eventually, everyone climbs upward together. Japan followed this path after World War II. Then South Korea and Taiwan. Then, in the 1990s and early 2000s, it was China's turn. Factories moved there. Manufacturing boomed. Hundreds of millions were lifted out of poverty. And the assumption in the West was almost automatic. China would eventually do what everyone else had done. As Chinese wages rose, low-end manufacturing would move on to Vietnam, Bangladesh, India, or Africa. China would become a service-based economy. The industrial core of the global system would remain spread out. That assumption shaped policy decisions for decades. Western countries outsourced production because they believed it was temporary. Companies dismantled factories because they believed they could always rebuild them later. Governments focused on finance, services, and technology, assuming manufacturing would take care of itself. But there was a flaw in that logic. It assumed China was playing the same game. In reality, China was learning from the flying geese model and quietly deciding not to follow it. Instead of letting industries move away as wages rose, China made a different calculation. Manufacturing wasn't just a phase of development, it was power. It meant control over supply chains, employment, exports, and eventually geopolitics. So rather than allowing factories to leave, China began automating them. Rather than giving up simple industries, it absorbed them into a larger system. And rather than specializing narrowly, it aimed for self-reliance across the entire industrial stack. This is where the global misunderstanding begins. From the outside, China still looked like a low-cost producer. But internally, it was building something very different, a fully integrated industrial ecosystem where raw materials, processing, manufacturing, logistics, and export capacity were all linked together. The rest of the world was expecting a gradual handoff. China was preparing to hold the entire ladder. And once you understand that mismatch in expectations, the next chapters start to make sense. Because what followed wasn't accidental. It was the result of deliberate choices made years before anyone was paying attention. To understand how China pulled this off, we need to stop thinking in terms of individual companies and start thinking in terms of systems. In most market economies, industries grow in a bottom-up way. Entrepreneurs take risks. Investors fund ideas. Competition decides winners and losers. Governments mostly stay in the background, setting rules and stepping in only when markets fail. China reversed that logic. Instead of waiting for markets to decide which industries would succeed, the state made that decision first. The question China asked was not, what are we good at today? It was, what industries will matter 10, 20, or 30 years from now? Once an industry was identified as strategic, everything else followed. Capital flowed toward it. Land was allocated for factories. Banks extended cheap credit. Local governments competed to attract firms. Universities adjusted training programs. Supply chains were built in parallel, not sequentially. To an outside observer, this often looked inefficient or even reckless. Too many factories, too much capacity, prices driven down to levels that made no sense on paper. But this wasn't a bug in the system. It was the mechanism. China didn't try to create one national champion per industry. Instead, it allowed and encouraged intense domestic competition. Hundreds of firms entered the same space. Margins collapsed. Only the most efficient survived. Think of it like a pressure cooker. In a normal market, companies are protected by patents, brand power, or investor patience. In China's system, protection was temporary. Subsidies were front-loaded, not permanent. Once an industry matured, support was gradually reduced. At that point, something brutal happened. Most firms failed, but the ones that survived were battle-tested. They had already endured razor-thin margins, supply shocks, and cutthroat competition. When they finally expanded abroad, they were competing against foreign companies that had never faced that level of pressure. This explains something that often confuses observers. Why do Chinese firms sometimes appear suddenly world-class, even though they seemed mediocre just a few years earlier? Because by the time they reach global markets, they've already fought a war at home. And this system doesn't rely on perfect foresight. China has backed industries that failed. Some initiatives went nowhere. Others underperformed expectations. But when the system works, it produces something extremely difficult to replicate: an entire ecosystem of suppliers, engineers, manufacturers, and logistics providers operating at scale. This is the foundation behind China's rise in industry after industry. Not a single breakthrough, not a single company, but a coordinated system that turns long-term planning into competitive advantage. Once this machinery was in place, it could be applied again and again, which is exactly what happened next. The first clear warning sign came from an industry almost nobody outside of trade circles pays attention to: shipbuilding. In the early 2000s, shipbuilding was a high-skill, high-capital industry dominated by a small group of countries. South Korea and Japan were the global leaders. Europe still built specialized vessels. China was a minor player, mostly assembling low-end ships with limited technology. In 2000, China accounted for less than 10% of global shipbuilding output. Then something changed. In 2006, the Chinese government officially designated shipbuilding as a strategic industry. This wasn't a slogan. It came with concrete actions. Massive state-backed financing, preferential land use along the coast, cheap credit from state-owned banks, local governments competing to attract shipyards. From the outside, it looked chaotic. Dozens of shipyards were built at the same time. Capacity exploded far beyond global demand. Prices collapsed. Western analysts said it was irrational. Japanese and Korean executives warned that China was creating a bubble that would destroy itself. Europe dismissed the move as low-quality overproduction. But once again, the chaos was the point. China wasn't trying to build one perfect shipbuilder. It was trying to stress test an entire industry. The goal was not short-term profit. The goal was long-term dominance. What followed was a brutal internal shakeout. Hundreds of Chinese shipyards entered the market. Most lost money. Many went bankrupt. Workers were laid off. Capacity was shut down. But the strongest firms survived, consolidated, and absorbed the capabilities of those that failed. By the early 2010s, something unexpected had happened. China wasn't just building more ships. It was building better ships. Container ships, oil tankers, liquefied natural gas carriers, eventually advanced naval vessels. By 2020, China had overtaken both South Korea and Japan to become the world's largest shipbuilder by output. Today, it produces more ships than the rest of the world combined. And here's why this matters. Shipbuilding isn't just about transport. It sits at the intersection of steel production, heavy machinery, advanced welding, electronics, logistics, and project management. Lose shipbuilding, and you don't just lose ships. You lose an entire industrial skill base. South Korea and Japan saw this shift early and tried to defend their positions. Europe largely didn't. By the time the decline was visible in employment numbers and factory closures, the ecosystem was already gone. What makes shipbuilding such an important case study is that it followed the pattern perfectly. Strategic designation, massive overcapacity, intense domestic competition, large-scale failure, global dominance by survivors. And once China proved this system worked in shipbuilding, it didn't stop there. It simply moved on to industries that mattered even more to the future of the global economy. After shipbuilding, China moved into industries that were far more strategic and far more underestimated. Energy technology. In the early 2010s, clean energy was seen as a Western strength. Solar panels were invented in the US. Battery research came from Japan, Korea, and Europe. Electric vehicles were niche, expensive, and experimental. China, once again, looked like the follower. But behind the scenes, a familiar pattern was forming. China identified batteries, solar panels, and energy storage as foundational technologies for the future economy, not just for climate goals, but for industrial power. Batteries, power electronics, software, and supply chains matter more than brand heritage, and China dominates those ecosystems. Because whoever controls energy technology doesn't just power homes, they power factories, data centers, transportation, and military systems. So the state stepped in. Chinese firms received cheap financing to build battery plants at massive scale. Solar manufacturers were subsidized to expand production far beyond global demand. Prices collapsed. Western companies complained of unfair competition. Many went bankrupt. Others exited the market entirely. At the time, this looked like a short-term problem. After all, cheap solar panels benefited everyone, right? But here's where the trap snapped shut. As Western producers disappeared, China didn't just dominate final assembly, it moved upstream into refining, processing, and critical components. Today, China controls the majority of global lithium refining, most cathode and anode processing, the bulk of battery cell manufacturing, over 80% of solar panel production. This matters because energy technology is no longer optional. Governments mandate renewables. Automakers are forced into electrification. Power grids depend on storage. And all of those systems depend on supply chains that now run overwhelmingly through China. At this point, price no longer tells the full story. Even if other countries wanted to rebuild these industries, they would face enormous barriers. Environmental permitting that takes years, a lack of skilled labor, missing supplier networks, higher costs without subsidies. In other words, the world outsourced not just production, but capability. Energy became cheap, but dependence became permanent. And once again, China didn't pause to celebrate, because the next industry on its list was even bigger, even more politically sensitive, and even harder to reverse. Transportation, specifically cars. And that's where the story truly started to shock the world. For decades, the global auto industry felt untouchable. Germany had engineering. Japan had reliability. The United States had scale and branding. Cars were complex machines with deep supply chains, strict safety standards, and enormous capital requirements. The assumption was that no latecomer could seriously disrupt this industry without decades of experience. Then electric vehicles changed the rules. At first, EVs were dismissed as niche products, expensive, limited in range, and dependent on government subsidies. Western automakers treated them cautiously, worried about protecting their profitable gasoline models. China didn't. Instead, it treated EVs as a reset button. Electric vehicles removed much of the mechanical complexity that gave legacy automakers their advantage. Fewer moving parts, simpler drivetrains. Software and batteries mattered more than engines and transmissions. China moved fast. Local governments subsidized EV startups aggressively. Consumers received incentives. Charging infrastructure was built at scale before demand even existed. Hundreds of companies entered the market. To outsiders, it looked absurd. Too many brands. Too much capacity. Too much money being burned. Analysts predicted a massive collapse. And they were right, but not in the way they expected. Most companies failed, but the survivors emerged with something no foreign competitor could easily match. Massive production scale. So integrated battery supply, rapid design iteration, extremely low costs. By the early 2020s, Chinese EVs weren't just cheaper, they were better. Longer range, smarter software, faster charging. Meanwhile, Western automakers were still trying to retrofit old factories and supply chains built for gasoline cars. Here's the uncomfortable reality. Electric vehicles are now less about cars and more about industrial ecosystems. Batteries, power electronics, software, and supply chains matter more than brand heritage. And China dominates those ecosystems. Today, China produces more electric vehicles than the rest of the world combined. Its companies are expanding aggressively into Europe, Southeast Asia, Latin America, and the Middle East. Western governments are responding with tariffs and investigations. But once again, the response comes late. Because tariffs can slow imports by net core, but they can't undo lost capability. The EV story matters because it reveals a pattern that goes far beyond cars. China didn't just catch up. It used a technological shift to reset the competitive landscape. And once you see that pattern, you start noticing it elsewhere. In industries people thought were still safe. Industries that felt too advanced, too specialized, too capital-intensive to fall. Those assumptions are now being tested, and in many cases, quietly broken. And that brings us to the next phase of China's rise. The move into industries that sit at the very core of modern industrial power. At this point, it's tempting to look at everything we've covered and assume China's success comes down to one simple factor: cheap labor. But that explanation stopped being true a long time ago. Wages in China have risen dramatically over the last 2 decades. In many coastal regions, factory wages are now higher than in parts of Eastern Europe, Mexico, or Southeast Asia. If low labor costs were the key advantage, manufacturing should have already moved elsewhere. Yet it hasn't. The reason is that China's real advantage is not cost. It's coordination. In most economies, different parts of the system move independently. Companies decide where to invest. Banks decide who gets credit. Universities decide what to teach. Infrastructure is built slowly, often years behind demand. In China, these pieces move together. When the state decides an industry matters, it doesn't just subsidize companies, it aligns the entire ecosystem around that decision. Financing, land use, education, logistics, and regulation all shift in the same direction at the same time. That alignment creates something rare, speed at scale. This is why China can do things that seem impossible elsewhere. Entire supply chains appear almost overnight. Industrial parks spring up fully connected to ports, rail lines, and power grids. Engineers graduate with skills tailored to industries that barely existed a decade earlier. None of this guarantees success. China has backed industries that went nowhere. Some projects wasted enormous amounts of capital. Others failed quietly and were shut down. But here's the key difference. In many countries, failure ends the experiment. In China, failure is treated as data. Industries are adjusted, merged, or abandoned, and resources are redirected to the next target. This makes China's system resilient in a way that's often misunderstood. It doesn't need to be right every time. It just needs to be right often enough. And because this strategy operates over decades rather than election cycles or quarterly earnings reports, it can absorb losses that would be politically or financially impossible elsewhere. That long-term horizon changes everything. It allows China to accept short-term inefficiency in exchange for long-term control. It allows overcapacity to function as a competitive weapon. And it allows industries to be built for endurance rather than immediate profitability. Once the system was proven in shipbuilding, energy, and electric vehicles, the next step was inevitable. China would apply the same logic to industries that were once considered completely out of reach. Industries that form the backbone of modern economic and military power. And that's where the story becomes far more uncomfortable for the rest of the world. For a long time, there was a quiet assumption in the global economy. Even if China became dominant in manufacturing, there were certain industries it would never truly control. Industries that were too advanced, too capital intensive, too dependent on decades of accumulated expertise. Things like precision machinery, advanced chemicals, aerospace components, and industrial automation were seen as the permanent strongholds of the United States, Europe, and Japan. But that assumption is now breaking, and it's breaking in the same quiet way the earlier shifts did. Let's start with advanced manufacturing equipment. Factories don't run on finished products. They run on machines, tools that cut, mold, weld, measure, and assemble with microscopic precision. If you control those machines, you control who can manufacture competitively. For decades, companies in Germany, Japan, and the United States dominated this space. Their machines were expensive, highly specialized, and nearly impossible to replicate without decades of engineering experience. China began by importing them. Then it began repairing them, then modifying them, then building cheaper alternatives. At first, those alternatives weren't very good. Western buyers ignored them. Chinese firms used them domestically instead. They accepted lower performance in exchange for learning. Over time, the gap narrowed. Today, Chinese firms are increasingly competitive in industrial robots, CNC machine tools, factory automation systems, measurement and inspection equipment. These machines are no longer just good enough for domestic use, they're becoming good enough for export. And this matters because once manufacturers can source advanced equipment locally, dependence disappears. The same shift is happening in chemicals. The global chemical industry underpins almost everything: plastics, pharmaceuticals, fertilizers, electronics, coatings, and advanced materials. It's capital intensive, regulated, and extremely difficult to enter. China spent decades importing chemical know-how. Then it invested heavily in domestic production, built massive chemical clusters, trained thousands of engineers. Today, China is no longer just a chemical consumer. It is a chemical superpower, increasingly competing with long-established European giants across both basic and advanced materials. A similar story is unfolding in aerospace components, satellites, drones, and industrial electronics. These aren't flashy consumer products. They don't generate viral headlines, but they are the quiet foundations of economic and military power. And once again, the pattern holds. China doesn't leapfrog overnight. It enters early, accepts losses, learns internally, scales relentlessly. By the time the rest of the world notices, the competitive gap has already closed, or is closing fast. What's especially unsettling is that many of these industries depend on ecosystems that take decades to rebuild once lost. Skills fade, suppliers disappear, universities stop training specialists, investment flows elsewhere. This is why the shift feels irreversible once it reaches a certain point. And it raises an uncomfortable realization. If China can compete in industries that were once considered untouchable, then the list of safe sectors may be far shorter than most policymakers assumed. Which leads directly to the question many governments are now asking, perhaps too late. If tariffs and trade barriers are the answer, why don't they seem to be stopping this? When governments finally began to realize what was happening, their first reaction was predictable. Tariffs, trade barriers, export controls. If China was winning by selling cheaper goods, then raising the price of those goods should level the playing field. That was the logic. And at first glance, it makes sense. Tariffs can slow imports. They can protect domestic producers in the short term. They can buy time politically. But here's the problem. Tariffs don't stop capability. They only affect trade flows, not the underlying ability to design, manufacture, and scale products. And by the time tariffs are imposed, China often already has something far more valuable than market access. It has the industrial ecosystem. Take a step back and think about what actually makes an industry competitive. It's not just factories. It's suppliers clustered nearby. It's engineers who know how to fix problems at 2 a.m. It's logistics that move parts in hours, not weeks. It's experience built through thousands of production cycles. Tariffs don't dismantle any of that. In fact, in some cases, they make China stronger. When exports become harder, Chinese firms redirect output inward. Domestic competition intensifies. Weak firms die faster. Survivors consolidate and become even more efficient. Meanwhile, companies in tariff-imposing countries face higher input costs. They pay more for components. Their margins shrink. Investment slows. This creates a paradox. Policies designed to weaken Chinese industry can end up accelerating its internal consolidation, while hollowing out domestic producers who still depend on global supply chains. There's another issue tariffs can't solve: time. Rebuilding lost industrial capacity isn't like flipping a switch. A factory can be constructed in a year or two, but the ecosystem around it can take decades. Skilled labor doesn't appear instantly. Suppliers don't relocate overnight. Engineers don't gain experience without years of production. So even when governments announce reshoring initiatives or industrial revival plans, the gap doesn't close quickly. In many cases, it continues widening while the rebuilding effort struggles to get off the ground. This is why so many trade measures feel reactive rather than strategic. They're responding to outcomes, not causes. By the time tariffs are in place, China isn't just exporting products. It's exporting standards, processes, and learning curves that others no longer possess. And this leads to a more uncomfortable realization. The challenge isn't that China is trading unfairly. The challenge is that China has already built what others dismantled. Which brings us to an even deeper layer of this story, one that goes beyond factories and finished goods. Because industrial power doesn't just come from making things. It comes from controlling the materials and processes that make making things possible in the first place. When people think about industrial power, they usually picture factories, assembly lines, robots, finished products rolling out the door. But factories are only the surface layer. Beneath them sits a quieter, far more decisive layer of the global economy: materials processing and refinement. This is where China's advantage becomes much harder to unwind. Most raw materials are not usable in the form they come out of the ground. Ores must be refined, chemicals must be processed, components must be purified, combined, and shaped into forms industry can actually use. And over the last 2 decades, China didn't just build factories. It built the middle of the supply chain. Take a simplified example. Copper might be mined in Chile. Lithium might come from Australia. Rare earths might be extracted in Africa. But before those materials become batteries, electronics, motors, or machinery, they often pass through Chinese refineries and processing plants. This creates a subtle but powerful dependency. Even if a country has access to raw materials, it may not have the capacity to process them at scale. Building that capacity requires massive capital investment, environmental permitting, specialized engineering, and years of trial and error. China built this infrastructure while much of the world focused on downstream assembly or upstream extraction. As a result, it now controls key choke points, not because it mines everything, but because it processes so much. This distinction matters. You can't simply replace a refinery the way you replace a supplier. Processing capacity is slow, expensive, and politically difficult to build, especially in countries with strict environmental regulations. That means supply chains don't just depend on trade relationships. They depend on physical infrastructure that took decades to construct. And once an industry becomes dependent on a particular processing hub, shifting away becomes extremely painful. This is why resource control today looks different than it did in the past. It's not about owning the mine. It's about owning the step between the mine and the factory. China understood this early. While other countries debated whether manufacturing was worth saving, China invested in the unglamorous middle: smelters, refineries, chemical plants, component processing facilities. These don't make headlines. They don't create famous brands. But they decide who can produce at scale and who can't. And this brings us to a critical turning point in the story. Because once countries realized how dependent they had become, the global economic system began to change, not gradually, but structurally. The era of smooth globalization started giving way to something very different. For a long time, globalization felt inevitable. Supply chains stretched across continents. Components crossed borders multiple times before becoming finished products. Efficiency mattered more than resilience. If something could be made cheaper somewhere else, that's where it went. This system worked, as long as nothing went wrong. But once countries began to realize how concentrated key industries had become, Confidence in that model started to crack. The turning point wasn't ideological, it was practical. Pandemics disrupted shipping. Geopolitical tensions exposed vulnerabilities. Energy shocks revealed dependencies no one had planned for. Suddenly, governments began asking questions they hadn't asked in decades. What happens if supply is cut off? What if critical components become unavailable? What if an entire industry depends on infrastructure we don't control? These questions mark the beginning of a shift away from pure globalization towards something more fragmented. Instead of one integrated global system, the world began drifting toward multiple industrial blocks, each trying to secure its own supply chains, technology, and production capacity. China didn't start this shift, but it was prepared for it. Because while much of the world optimized for efficiency, China optimized for control. It accepted higher costs in some areas in exchange for independence in others. It built redundancy where others removed it. It treated industrial capacity as a strategic asset rather than a line item on a balance sheet. When fragmentation began, China already had most of what it needed. Other countries, by contrast, found themselves scrambling. They announced reshoring initiatives. They offered subsidies to rebuild factories. They talked about supply chain resilience, but rebuilding is far harder than maintaining. Factories can be relocated, but ecosystems can't be conjured overnight. Suppliers need to be nearby. Skilled workers need training. Engineers need years of hands-on experience. Infrastructure needs time. This is why fragmentation doesn't level the playing field. It often locks in existing advantages. Countries that already control supply chains gain leverage. Countries that outsource them face long, expensive rebuilding cycles with uncertain outcomes. And this is where the quiet nature of China's rise becomes especially important. China didn't dominate industries by breaking globalization. It dominated them before globalization began to fracture. So when the system started pulling apart, the pieces didn't scatter evenly. They clustered around places that already had industrial depth. Which brings us to a difficult realization. The real consequences of China's rise aren't just economic, they're structural. They shape what countries can and cannot do in the future, regardless of political intent. And that raises the most important question of all. If this shift is already underway, and if rebuilding takes decades, what does that mean for the global economy going forward? That's what we need to confront next. One reason this shift went unnoticed is because industries rarely collapse all at once. They thin out quietly. A supplier shuts down. Investment slows. A factory stops upgrading equipment. Jobs disappear gradually, not dramatically. From the outside, everything still looks normal until suddenly it isn't. Another reason is timing. China's rise didn't come through a single breakthrough or crisis. It unfolded across decades, buried in trade data, supply chains, and industrial decisions that rarely make headlines. By the time the pattern became visible, much of the ground had already been lost. When one country controls large parts of global industry, the effects ripple outward. Prices become more volatile. Supply chains grow fragile. Political disagreements start carrying economic consequences. Manufacturing power translates into bargaining power. This doesn't mean the global economy collapses, but it does mean it becomes less flexible. Countries that lack industrial depth have fewer options when disruptions occur. They can negotiate, subsidize, or delay, but rebuilding capability takes time they may not have. China's dominance isn't guaranteed forever. Demographics, debt, inefficiencies, and geopolitical pushback all impose limits. Other countries are already responding with industrial policy, reshoring efforts, and strategic subsidies. But these responses face a hard reality. Rebuilding ecosystems is slower than losing them. The next decade will likely be defined not by a reversal of China's rise, but by attempts to adapt to it. This story isn't about blame, it's about structure. China didn't take over global industries by accident. It did so by treating manufacturing as strategy, not nostalgia. The real question now is simple but uncomfortable. In a world where industrial power shapes economic and political outcomes, who is prepared to build patiently and who is only reacting? That answer will define the next chapter of the global economy.